This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. This is going to be another one of my combination episodes. Now you might think I'm being lazy. I'm not recording new material. That's far from the truth. But look, at 500 plus episodes, doing this podcast since January of 2012, I've got a lot of material. And a lot of that material gets buried. People don't get a chance to listen to it all. Frankly, where do you start? 500 episodes. I tell people to start at number 1. Why not? Well, that's probably weeks and weeks of listening. Now it's worth your weeks and weeks of listening. But I've developed this technique in the last few months, these mega episodes, taking great content, great what I would call evergreen content, classic, timeless content from my interview back catalog, and combining it together, combining those episodes together. Today's show, 3 combined interviews, 3 trend-following traders. First, Christopher Cruden. What I love about Chris, he's got a trend-following perspective only for currencies. Great insights, a really cool story. Second on the show today, one of my favorite traders of all time, Salem Abraham, featured across several of my books. His hometown, where he still has his core business, Canadian Texas. I have not been there for several years, but some of my most favorite life experiences took place in Salem's hometown. Specifically, the one that I can still recall, and I don't know if these were antelope or gazelle, but his brother taking us up in his helicopter and deciding to see what kind of G's he could pull as we got down, 25 feet off the ground, chasing gazelle across the ranch in northeastern Texas. Yeah, that was pretty damn cool, really. I think back about it, that was just one of those great experiences. Salem, he was my last chapter in my book, The Complete Turtle Trader. And if you can't learn something from Salem Abraham, you need to go get your head examined. My third guest on this mega episode, one of the original turtles, Brian Proctor. Brian gives that perspective, that insight into how he came to be, all of his experiences, and where he is today. Great stuff. So let's jump right in. First, Christopher Cruden. Before we dig into your background, your current firm, and all that kind of fun stuff, I want to go back in time to something, a little nugget that I put in my first book, Trend Following. And I want to read this verbatim, and it's quoted to you. And it says, quote, "I would prefer to finish with a certain currency forecast based upon my own fundamental reading of the market and one that underpins my personal investment philosophy. The only problem is I can't tell you when this will happen or which event will be first. On that basis alone, it seems best to stay with our systematic approach," end quote. Okay, are we done our interview?
Yeah, that's about it, I'm afraid. I can't sing, you can't watch me dance, so that's about it.
That's a great, great line. And I did not know you when I put that in there. I just thought it was one of those nuggets I had saved. I was like, it's just such a clear... And this is going back in time, and this is not new to you. You've had this attitude and this view going back to when? When did you become this man with this view?
When I discovered that everybody else I ever met was smarter than me, I thought I'd better stick with what I knew was an unimpeachable fact. And in terms of trading, that seems to be price. Everything else is some sort of weighted opinion or subjective opinion. And when it comes right down to it, I'm not terribly comfortable with besooted soothsayers and readers of tea leaves and chicken bones. So The price is the only reality. And so, I'm happy to stand at drinks parties and give people my utterly meaningless and worthless and often wrong views. They're not really based on anything, are they? And my suspicion is nobody else's are either. It's almost like a circus trick. You watch these economists on TV, the sort of talking heads, and some of them are very entertaining, very amusing, and some of them are occasionally right. But I don't think I'd spend money on somebody's view.
Was there a point in time, a trigger as a young man, where, I mean, you could have gone down the Eugene Fama route, you could have gone down the Warren Buffett route, but you didn't. So what was the pivot? Why did you not do that?
When I started off with Deanwood Reynolds years ago, and worked under the Managed Futures department there in Graham Capital, and Kentropin and all of that sort of stuff. So we met a lot of really clever guys, but many of them were, it seemed to me, systematic trend followers. When I came back to London in '88, I had a friend of a friend who was a very senior person at a firm called Singer & Friedlander, and he said, I don't know what you do, but I know some people who do what you do, I think, as much as he understood it, because it was a very old British sort of stockbroker and that sort of environment back in the cities back then. He introduced me to Mike Adam at Adam Harding and Lewick. And it's a typical sort of British thing. Mike Adam and Marty Lewick had gone to a public school along with my wife's brothers, and it was very, very British. I met Mike, and we decided that I would join AHL, and in those days there was AHL was AHL. I think we had a secretary called Eloise, and that's about it, really. And then Martin Hunt, who was a brilliant guy, who used to execute the trades. So I joined them, and then I got a call from Mike, and he said, actually, I want you to meet David. I said, well, that's great. I'll look forward to meet David. David Harding, this is. And I said, okay, fine. So I went to see David. And David was showing me on one of these huge, big CRTs that they had back then, which was color, which was kind of unusual, because we're talking sort of Pac-Man visuals here, but this one had color on it, had graphs on it, and his fingers would fly across the keyboard and another graph would come up, and then it would go into a heat map. Who the hell had ever seen a heat map? I mean, this is way before PowerPoint or any of that sort of stuff. I probably sort of looked askance at all of this, but what I was thinking was, could I do this? I mean, do I understand all of this? So I was looking sort of in a sort of a questioning way, and David sort of stopped and he pushed the keyboard away, and he looked at me and he said, are you questioning what I'm saying? Which I wasn't at all. I'm not in the slightest. I was in total agreement. And I said, no, I'm not questioning what you're saying. And he said, good, because we have the intellectual high ground on this, which at the time I thought was one of the most arrogant things anybody had ever said to me. And having been in the British Army, there's a lot of arrogant things that have said, but this set a new record. But I thought about that over the time I was with AHL. They did, in fact, have the intellectual high ground because they were ferociously clever people. David, Michael, and Marty, as now aspect, ferociously clever people. And sensible people, too, despite the fact that those days were all less than 30, I suppose. What I realized from that moment was that I was not going to be as clever as them. So what I decided to do was to take the one kernel of information, the one nugget from my experience with them and my smaller previous experience and much of my later experience, is that simple works. So what was the simple thing that AHL and other successful trend followers do? It is limit the amount of inputs, limit the number of parameters, and have the discipline and the conviction to follow your system. And so that's what we do. And I know that in this business people dress it up all sorts of different ways, but when it comes right down to it, that's all we do. What we do is in fact pretty simple.
Let me ask the question, your differentiating point as a trend following trader primarily, the notion of going currency only, 7 currencies. This is your primary vehicle for applying trend following, correct?
Yes.
Talk about that. That's original. That's different, isn't it?
It was at the time we did it. After AHL was bought by Man, I moved back to New York, and there was a man there called Bob Toniso, who was my great mentor. He was an extraordinarily important man to me in my life and development. He was a systematic trend follower. His best mate was Larry Height. So Larry was always in the office and this, that, and that. We're talking 91, 92, 93, around about that time. Bob's CTA number with the NSA was something like 6 or something like that. So he'd been in it for a long, long time. And we noticed that at that time there were like 4, 5, 6, 7, 8,000 CTA registrations. And we thought that the business would become overcrowded, become overpopulated. We didn't like what we saw in some of the smaller agricultural markets and the metals markets and that sort of thing. So we thought we would, the belief was, I say it quite often, but the belief was that markets take on the personality of the participants, and if the participants are overextended, overleveraged, easily excited, inexperienced, easily spooked, this is in fact a bad market to be in. So we looked for a market that wasn't that, and we found what was those days the interbank currency markets, which were by definition a professionals market. They also have even back then, the advantage of being utterly and truly bidirectional. Stock markets clearly aren't, bond markets clearly aren't. Some futures markets you would argue that are or are not to a greater or lesser degree, but currency markets absolutely are.
Truly surfing, right?
Yeah, absolutely. It's just long dollar yen is short yen dollar. I mean, it's not hard. And there's no cost or moral view or legal impediment. It's just they were perfect markets. And so they loaned themselves, because of the serial correlation that currencies seem to exhibit, to our kind of approach. So, and with the product that came out was called Kintyre, which was, in those days we traded forwards. I think there were 28 different prices, and it was, in effect, it was a sort of a one-size-fits-all algorithm, believe it or not. And, it surprises people today to hear, but we never even had a price feed in the office. That's not just because Bob was cheap, but because it doesn't, watching red numbers change to green and back again isn't a particularly sort of constructive way of spending your day, especially if your holding period is as long as it was. So, of course, now it's entirely different. Now we've got all sorts of clever gubbins, which, as you've seen with the experience with Skype for this call, I don't fully understand. But nonetheless, back then there was none of that. So we traded once a day, as we do now, and everything was pretty simple. And the program itself was very successful. It had periods that weren't successful. Then it had periods that were extremely successful. I think in the 9, 10 years we ran the program, we probably had 2 losing years. The worst one was, I think, down to 2.54 or something like that. And other years were 30, 40, 50, 60% or more. So a very successful program.
I saw one of the comments in your newsletter quoting the Doors line, "Riders on the Storm."
Yeah.
And noting that your program is something akin to a raincoat in bad weather. But that's not necessarily true in the sense that it's not only then that you can make money. I mean, you can make money.
Oh, no.
Yeah, exactly. So why don't you expand on that idea?
Well, in fact, that particular report, Riders on the Storm, I think we put that out about 15, 18 months ago. And we have just redone it. We've just redone the numbers. We haven't changed any of the words of the report because they're still valid and hold true. But we have changed or updated the files and graphs and charts and the numbers, that sort of thing. So we were early in putting that out. The benefit of a traditional portfolio, or specifically an equities portfolio, which is what Riders on the Storm concerns itself with, is entirely, from our point of view, accidental. It's an observed fact that exists with our program, rather than an objective that we set out to produce something. We didn't set out to produce something that assisted a portfolio of equities. It just so happens that after 14 and a half years, this is an effect for equity investors. But it wasn't what we set out to do.
How do you describe operationally to investors? So we have a crazy period in the market, something like October of '08, and your portfolio starts to do well. Equities are doing bad. But why don't you walk the audience through the idea of what's happening? When equities start to go bad, people start to sell, and what operationally is happening that gives you the benefit to ride this increased volatility, this increased directional trending within your currency-only portfolio?
The answer to that question is to look at what are currency markets, and currency markets are basically markets for capital flow. So as there are seismic changes, such as a stock market declining 50% over a relatively short period of time, which they've done twice in the last decade or so, and vice versa. I mean, these are sort of big events. I didn't just mean the day of the quote-unquote crash, but I mean they are seismic events. And increased M&A activity, for example, it was really popular to ascribe certain moves to that sort of thing at one stage. What else would we have? The euro coming in, for example, everybody knew what the targets were, so that's pretty much a layout. But these are seismic events that are reflected, or best reflected, in the market most appropriate for them, which is the foreign exchange markets. We don't make those things happen. We don't make anything happen. We just hope to hold on while nothing is happening for the time in which something good will happen, and we know as a certain fact that it will happen.
Have you ever had and I'm saying this facetiously, have you ever had the Liechtenstein prince look at you and you say that you can't make it happen? Do some very well-heeled investors sometimes don't get that blunt, hey, I can't make it happen, but I'm still bringing you a very talented trading program with nice alpha generation, but oh, by the way, I can't force this to make money. Is that hard? That's hard for people to accept, isn't it?
It's very hard because it's sort of inhuman in a way, in the sense that people like to think they know a guy who knows something. And, it's hard if part of your presentation, or most of your presentation, is in telling them that you, in fact, are not that guy and you really don't know anything at all. So that goes down well with some and less well with others.
Well, I think it's once you start to open up and peel back the onion, so to speak, to get into the risk management, to get into the uncertainty, the volatility, how you're measuring things, how you're preventing the downside from going really down. I think it's when you start to open that up, I'm sure eyes start to perk up as well. Ears perk up.
Well, I think what we make a point of trying to explain to people that our job most of the time is in not losing money. I mean, as David Harding used to say years ago, you'll always make money in this business if you don't go broke first. And that's very true. Now, what's going to make you go broke? Well, being wrong isn't going to help, but most people go broke because of leverage. So we try and stay very small leverage relative to most currency managers, that's for sure, and survive long enough to be around for the happier days. Like Bob Tanisa used to tell define trend following as this. He says, imagine that every day you've got to go to a Manhattan, your junction on the street corner, and you've got your folding chair, and you've got your thermos of coffee, and you've got your sandwiches and greaseproof paper, and you've got to sit there. Well, the morning rush hour comes in, and you get jostled around, and then it goes home in the evening, get jostled again around. They knock over your thermos, they step on your sandwiches. You've got fumes of cars going by all the day. The weather changes, and this is a terrible way to spend your life. Until one day, the parade comes by, and you don't know which direction the parade's coming from. But when it does come, you've got the best seat in the house. And that's trend following. The secret is to stay on that street corner.
When you compare, you can have that attitude in life, or you can have the other attitude in life, which to me, and I'm not trying to sound mean, but to some degree, when you're a pure, let's say, equity only buy and hold index person, index investor, you're kind of pretending that it's never going to go down, and you're very comfortable trusting the powers that be to manage those equities and keep them going up. But the objective evidence says we're going to have those 50% melts. So it's just sometimes I want to use the word delusion. And I'm not trying to like talk the trend following book up, so to speak, but I sometimes really wonder how this conversation doesn't open up more honestly to where both types of thinking can go onto the table. Because I think if more people understood the way that you think, Chris, the way that others, many of your peers think, I think a lot more acceptance would go down.
Yeah. Well, first of all, when we get to this point in any conversation, I would say, well, hang on a second. What are we using? Well, first of all, in my view, there's only two things you need to get right in investment management. One is benchmark selection. Always, always, always pick a benchmark you can beat. And two, time period selection. So if you, with a selection of the right time period, be it 1 year, 5 year, 1 month, 3 days, whatever it is, anybody can look like a genius. And much of asset management is based around that. So I'm not being sort of dismissive of people who say they know tomorrow's prices, but basically these people are riding along in exactly the same way as they would say that we are riding along. They're only finessing it through benchmark selection and time period analysis. So that would be one point. The next point I'd make is most people would use, for example, in terms of asset management, a stock market index. Let's take, for example, the S&P 500. Well, the S&P 500 is in fact a trading system. It has certain rules, it has a certain number of criteria, and a certain number of rules. The most dominant rule or advantage that system has is it has the survivor bias. I mean, I haven't noticed Enron being in the S&P 500 recently, or WorldCom, or things like that. So they drop out. So it's only when they're going up are they in. But that's fine. But we also know that about 80% of equity managers who use that in particular index fail to beat it. And there are all sorts of reasons for that, and we won't beat them up on it. But basically, if people are using that as a benchmark, they already, in my view, have surrendered to the wisdom of systematic rules-based trading, which, that we all know, they don't beat. So from when somebody says, well, what if this happens, or what if that happens? What if it does? I don't see how what we do is terribly different from the S&P 500 or any other index that people might want to use. I haven't been in the business quite a long time. I've heard so many conversations, so many arguments, that for me at least, the evidence is pretty clear and compelling. I mean, systematic trading works better than random trading. Now, I know about the monkeys and the dartboard and this, that, and the other, but the fact of the matter is, none of them have written Shakespeare yet. Systematic, simple rules. I'm not saying it's not possible, but none of them have, to my knowledge. There's been a lot of bad books written, but the monkeys have not yet written Shakespeare. Your simple rules have some performance drivers. The performance drivers of your G7 currency portfolio. Number one, it's driven by the number of price reversals. Number two, it's driven by the number of losing trades. And number three, it's driven by profit size and duration of winning trades. Why don't you break those three apart individually for the audience? First of all, if we wanted to, you and I, because we have time and we're bright guys, if we wanted to develop the world's greatest trading system, it wouldn't take us long. What we'd be aiming for is a 3-to-1 win-loss, or 3-to-1 payout, risk over return, and maybe 50-50 win-loss. If we could do that, we'd have all the money in the world. I mean all of the money in the world. I don't mean large allegations, I mean all of the money in the world. We haven't done that. We have been unsuccessful in doing that. What we have got is we're about 60-40 losers over winners on average. In good times it's better, and in bad times it's not as good. But basically 60-40 on win-loss. So 60% of the time we lose on our trades. So when you look in the back of a commodity magazine, it says by our system 98% trades winners. I'm, after 35 years, somewhat skeptical, but everybody's got to earn a living. Hold on. You're telling me that if we buy those things in the back of the magazines that say 98% winners, you're telling me I am not going to be on easy street? Come on. Well, I see a lot of young traders, well, not young traders, people come and say, this is the system, we'll introduce people, meet this guy, and you look at the track record and you say, well, Jesus couldn't trade that well. It's just, I do this every day and have done for 30 years or more. Nobody can do that, in my view. There are periods of time when are better or worse than others, but some of these track records you see are a function of time period analysis, benchmark selection, and leverage. So from an investor's point of view, you have to be, extremely careful and somewhat skeptical going in. In terms of when our system basically has 7 currencies in it, 7 times 7 minus 7 divided by 2, so there should be 21 price streams that we trade. In fact, for reasons of liquidity, obviously, we don't trade all 21. We only trade 16 of them because 16 are the ones that meet up our criteria for acceptable liquidity. Now, the computer doesn't look at them as currencies. Computers are clever things and useful things, but all it sees is a row of numbers, 16 rows of numbers. And those rows of numbers have certain characteristics and relationships with the other members of the portfolio. So, for example, if I say dollar yen to you, you immediately think of Abenomics, or if you think of euro dollar, you think, well, Europe's in recession and Draghi, and the computer doesn't think any of that stuff. It's just numbers to the computer. So when we have these 16 rows of numbers, and internally we probably don't even refer to them as currency pairs in the conventional sense that most people do, because for us it is only price. Because price is the only reality. You look at the price, you say, well, that price is too high or that price is too low, and you might be right for all I know, but that's the good news. The bad news is it doesn't change the price. The price is the price, and so that's the main input for us. And when we make a trade, and none of this is new or radical perhaps, but with Larry Hite, for example, all trades, as he said, I think in Market Wizards one year, never made a bad trade. Well, is that an arrogant thing to say? No. What he's saying is that all trades are risk equivalent. And why are they risk equivalent? Well, because if you knew that this trade was better than that trade, you would make that trade, you just make twice as many of this trade. But you don't know that. So all trades are risk equivalent. We bet small. When we win $2.12 or 20 cents, whatever it is, depending on the time equivalent of. And when we lose a dollar. So that's where our edge is. But it's a statistical edge. It's not a knowledge edge. If you get my drift.
Absolutely. Hey, let me clarify too. When you say it's just the computer, that computer is just you and your associates automating yourselves. It's your thinking in the computer. You're telling the computer's not wildly doing things that you don't know. You're simply saying to the computer, automate our thought process. Here's our systematic thought process. Now go execute it.
That's exactly right. We don't, what we've actually done is, in our business, is just chock-a-block with cliches. Here's a cliche. In our system, for example, our losing trades are held for about 6 days on average over the 14 and a half years. Our winning trades are held for about 17, 18 days. Okay. Now, in statistical sense, what does that say? Well, what it says is you cut losses and run profits. That's what it looks like. But the idea of doing that, cutting losses and running profits, is a trader's cliche that everybody knows, but for some reason, most people can't do. But it's not hard if you set very simple rules, and that's what we have encoded. But it's not rocket science. We don't have PhDs here. I would take the view that all the best PhDs probably work for David Harding at Winton. So,
and he's probably the best one still, I would guess.
He is, everybody else is probably like either his cast off or reject, so why would I hire a PhD? Because what we're encoding isn't in fact that hard.
Hey, listen, you mentioned the duration of trades. Your research, you've shown though, the number of days for a winning trade appears to matter, but it's different for the number of days for a losing trade. Why don't you explain those differences that you found out in research?
When the system is not doing well, what you see is that the period is not because we're losing bigger amounts. There are two reasons that we lose money. One, because in the main, the losing trade holding period remains the same. It is the shortening of the winning trade holding period that is one of the most noticeable statistical phenomena of losing periods. So that's the one that becomes shorter, and of course that results in a higher trading volume. And having said that, our trading volume is positively Jurassic compared to most foreign exchange people. But when we in a bad period, you will find that holding period for losing trades remains approximately the same. Holding period for winning trades is foreshortened. But a bad period comes down to that for us, not because we took an absolute bath in this cross or a bath in that cross. That really doesn't happen to us in any sense.
And that's primarily, from having a rules-based approach and the most liquid of markets. This isn't like there's going to be some situation where you can't execute and get out of what you want to get out of or get into what you want to get into.
And that's why we trade what we trade, because if we were to trade, for example, and Lord knows we've looked at it 1,000 times and continually do, and even now we're looking at other currencies, but if you stick to the majors, or these in our case, these 16 crosses, there is a market for those. And more importantly, there is a price, because there is liquidity and you can have some confidence in the price. Yes, there may or may not be a gap, but it'll be a smaller gap than many other financial instruments that you can think of. So if you were to trade the real or the peso or the South African rand or something like that, well, now there is another thing other than price. There's politics, there's all sorts of things. Now, we don't have the foggiest notion how to measure political risk. We don't have the foggiest notion how to measure any risk other than price. And we take the view that if you can't measure it, you can't manage it. I'm not saying that other people can't and can't do so successfully, and I wish them good luck, but I know we can't, and therefore we don't.
Chris, as we wind down, I want to ask you one kind of fun question. I know you're a pretty pragmatic guy. I think the audience can see that. So I'm sure you're not sitting around wishing or hoping. But business would be even more interesting if one day that the powers that be in Europe decided that the euro needed to go back to what it was before the euro. That would give more opportunities, would it not?
Prior to the introduction of the euro, we only traded the Deutsche Mark as a proxy for Europe, and that has to do with correlation or changing correlation. So pre-euro, you could have, theoretically, 6 or 7 tradable currencies, but in times of great stress or difficulty, you'd actually end up with one position 7 times as large as you hoped it would be. Now, to avoid that, we only ever trade Deutsche Mark. If it went back to pre-euro currency, so lira and guild and all that sort of thing, then we would probably take the same view that there is one European currency, and that would probably be the Deutsche Mark. In other words, we would reverse the decisions we took when the euro was coming in. But they certainly would be exciting and potentially profitable times.
It's interesting perspective, though, that essentially you were already trading the euro before the euro.
I think we were, and I think many people were. I mean, as I say, what we do is it's not unique or clever. I mean, some people might think it is, I don't know, but to me it's pretty obvious. This is not hard. I mean, you can discount a lot of things very quickly. Or you can go on some sort of academic scavenger hunt and convince yourself that you're Einstein, which is fine. But it's a big church.
I miss living in London. I miss the dry sarcasm, the academic scavenger hunt. I miss it.
Well, as I say, this is not hard. What is hard is doing it.
Yeah.
It's hard to come in and see that you've got another reversal, and you've got another reversal, and you've got another reversal. That's hard. But the reason that it's worthwhile is because when it does go your way, it goes like a train. And the reason that we take things like reversals and this, that, and the other, and we get whipsawed, which is the sort of no word of trend following, but it's because of what we know is, and I think maybe some investors don't know this, but if you lose a dollar, it's harder to make back that lost dollar than it is to make a new dollar because of volatility drag. For example, if I lose 25% in the stock market, I don't need to make 25% to get flat. I've got to make 33 1/3% to get flat. That volatility drag is really punitive. It is an additional price for being wrong. The reward for being right is not as great as the reward or the penalty for being wrong.
And I guess with clients also, the reward for being right is, well, you're not allowed to be wrong anymore. Just keep being right all the time.
Well, a rising tide lifts all boats. And, I think everybody, yourself especially, and myself and many others who do what we do the way we do it, we've seen this before, and if we live long enough, we'll see it again. Yeah. A lot of people get it. We've got a whole generation now of asset managers, young guns who've come in and seen the stock market double.
Yeah, and that's their starting point. I mean, think about how many young people are essentially got started, young traders, professionals, and got started in early 2009, and their frame of reference is simply straight up.
Absolutely. Buy stocks, they go up.
Yeah.
Everybody knows that. We actually saw the similar sort of thing in the 90s, didn't we?
Absolutely.
Yeah, and you find people who will say to you, they talk as if it's a God-given right to make, back in those times, 20% a year in the stock market. Hello?
I still remember the NASDAQ, what was it, 100% in 1999 it went up. It was crazy.
Absolutely. Absolutely. And up it goes. And on average, you're making these huge returns. Markets don't exist to make you rich. They're not here for your enrichment or entertainment. They're here to teach you humility. And that's what they do better than anything else that I've ever experienced. They teach you humility. After periods such as this, we forget that markets halved. Why? Markets are doubled. They're brilliant. Let's talk. They're like a bad trader. You walk through a trading room, and the trader will come and tell, well, you do so-and-so, that's great, blah, blah. But let me tell you, I bought the yen when it was down, and now it's up. So, yeah, okay, so you're telling me you're actually good trades. One of the parts that's missing from the conversation is your bad trades.
So, you're sitting here talking about humility, and there's plenty of young traders out there thinking, hold on, but really what's going on in the office, Chris? You guys are like all jacked up on coffee, and there's a huge adrenaline rush, and there's screens flashing, and everything's popping, and there's bells going off, and you guys are just going at it all day long. I mean, you're just not telling the truth, Chris, about how it really happens at the office.
Well, this place is like a graveyard. We don't allow anybody to watch screens. I mean, we trade once a day at London 1 p.m. And after we make those trades, we're done for the day. That's it.
But that's not a cavalier statement. That's just an objective, factual statement. But as we've been talking this whole conversation, there's a lot of depth of understanding that goes in to allow you to make that kind of objective statement. But you're not trying to be arrogant or like, hey, we only trade at 1 p.m. You're just saying this is a matter of fact. This is what we do operationally based on our system.
Yeah, well, it's the deepest, most liquid time for FX markets, point one. And point two is, again, it's something that we have to do it that way because that makes it measurable. If we came in and decided, for whatever reason, randomness would be a reason, to trade at a different time every day, well, that would be kind of more difficult to measure. So it's not arrogance. In terms of arrogance, I yield to no man. But there is a reason that we do things the way we do things, and I wouldn't for a moment pretend that other people don't have good reasons or better reasons to do things differently. As I say, good luck to them.
Hey, Chris, you guys put out a lot of great research, a lot of pieces of writing, and I know you talked about something I've not had a chance to see yet. Hopefully we can talk again here in the months to come. But where can people go to check out your firm, see some of the papers that you've written, some of the information you've put out? Where can people go?
Well, our website is www.inch.invest. Now, Inch is spelled with a C, so it's INSCH invest.com. Our head of research is Pernod Schneider, and although my name goes on it, and I take partial credit for what she does, in fact, most of the donkey work is done by Preneur and Rivaldi Kwan in London, and Philip Balich, who's also here in Lugano with us.
Is that more of the humility? What you refer to that the trading system and the efforts as the donkey work? I don't know if I've heard that one before, but I love it.
Well, there might be somebody who has a sort of a spark of genius, like the Sistine Chapel, the spark from the finger, and I would credit myself as. Occasionally I come up with a good idea, but rather like trades, most of my ideas are bad ideas. They have to be researched and tested, and Rivaldi and Philip do that. And so, again, exactly the same as I just said about a trader, most of the things I think of fail to pass scrutiny in the end. But some of the research reports that do come out, we are often complimented on it. And the great thing about being us is that we're beholden to nobody. I don't have to trade through anybody. I don't have to do anything for anybody or to anybody. And I really don't care what anybody might say. So on that basis, we are pretty free in looking at what we would look at and concluding whatever it is that we conclude.
I think for the audience out there, whether it might be a potential new investor to your firm or an established investor or just a young person looking to learn from you and your associates and your work, go look at Chris's track record. Just go look at the monthly ups and downs, look at the annual totals, just look at everything and observe that it's not all black ink. There's some red ink in there. And I think that's what for me, I've always taken that when you look at a trend following track record and you look at that red ink, if you don't see the red ink, there's trouble. And if there's no red ink, it's not trend following.
You're absolutely completely correct about that. And that's what I tried to allude to in the morning. I see some earlier in our conversation, I see some track records. I look at it and with the one blink test fail. Yeah, I don't think so.
Yeah,
I don't think so. And I'd hate to be cynical about this, but going back into those olden days, if people or clients are making allocations to trend followers, guess what? You see a hell of a lot more people describe themselves as trend followers, and extend that to managed futures. If managed futures does really well, guess what? Megabank PLC or whatever, they're producing a managed futures fund. Do they know anything about it? Not a bit. But that's okay because they're paid on assets under management.
Yeah.
Do you see what I mean? If there is a demand, supply and demand, the supply will rise to meet the demand, and that's true of investment management. So if, for example, trend followers over the next 3, 4, 5 years do really, really well, you'll see a lot of people rebadging themselves as trend followers. It's to be expected. It's obvious.
As you mentioned that quick peak idea, I always say, and I've said this before, if you see a track record, and for example, I can think of two famous track records in the last 15 years, Bernard Madoff's, which was a scam, and Long-Term Capital Management's, which was just a bad process. But both of them showed you that consistent 1 or 2% a month. And so to me, it's like if you see, and this might sound crazy to investors, if you see a track record that shows plus 1% for every month of the year, that scares me more than a track record that might show a minus 7% or a minus 8% a month. It's the plus 1% every month that should scare the bejesus out of you.
Me too, because it is simply not doable in my experience.
Yeah.
As I say, these places aren't there for your enrichment, and somebody who's going to make 1.25% a month and has done for the last 42 months. I'm sorry, fill your boots, write the check. But for me, no. When
you see that track record, there's something else going on besides the track record. The track record is funky, to say the least.
Yeah, but there's a lot of it about.
Yeah. Hey, Chris, listen, great conversation. And I want people to go check out your website, check out your writings. And like I said, hopefully we can talk again in the future. And like I said, I go back to reading that opening quote that I put in my book. And my gosh, I probably found that 2002, 2003 when I first saw it. So I pulled it up today. I was like, I got to pull that quote up that I put in my book from Chris. So.
Well, since those days, which is a long time, it's got to be well over 10 years, I can assure you we haven't learned any more new things, but we've learned more about what we don't know. That's for sure.
Well, as you say with humility, there's another humility statement right there. Hey, Chris, I appreciate you coming on today, and thank you again.
Thank you very much indeed, Michael. Thank you. Bye-bye.
Now for my second episode on this mega episode, Salem Abraham.
Michael, how are you?
Hey, Salem, how are you?
I'm doing well. Good morning. Good afternoon to you. What time is it over there?
I'm at 10:15 p.m.
Wow. So almost good night.
Yeah. But this is called podcast dedication. So,
good.
It's a perfect time for chatting and catching up. So, hey, how is economic development in Canadian these days?
Well, with the oil and gas market going off the cliff, it's kind of sliding. So it's, but now it's really been booming the last 6 years or so.
Yeah.
So yeah, it's been blowing and going. I guess it took a little bit of a hit in 08, 09, late 08, early 09, but then that seemed to recover pretty quickly. They kind of transitioned from drilling a lot of natural gas wells to then the oil wells, and now both oil and gas are both low, so they're kind of the drilling's slowing down, and everybody's kind of scratching their head. But it's still a nice town. It's still good by my standards. So
well, hey, I miss the bread pudding at your steakhouse down there. So
that is good bread pudding.
It is. I
agree with that.
Absolutely.
Yeah, it's nice. Are you okay? You're doing fine. You're enjoying. Yeah, you're living in Singapore now.
I'm in Saigon right now, in Vietnam right now.
Okay. Now, are you living in Vietnam?
I don't know what the definition is. I've been in Asia for the last 2 years. I essentially did a huge speaking circuit, and I did not plan to stay after 4 months of speaking in 8 or 9 countries and 45 presentations later. I was like, wow, I really don't want to go back to San Diego at this moment.
Yeah.
One thing happens, and then the next thing you know, and so it's nice.
Good.
It's nice.
Well, a lot of people really love it over there. I know I have a friend that talks highly of Singapore, and so I know there's a lot of nice places over there to spend time, and it's interesting cultures, and so yeah, they've
really the econ development, they kind of reminds me of the feeling that the boom periods you've seen in Texas, but I would think of even the 1980s booms in America. It somewhat feels like that the kind of just growth. It's exciting.
Good.
Yeah. Let me ask you not the tough question, but the interesting question that I think has probably been something that near and dear to you. I remember having a conversation with you talking about your Euro-dollar lessons from 1987. I think if we bookend that with the Swiss franc, it probably have had to brought back memories, that type of a move, huh?
Yes, absolutely. It did. So October 20th of 87, so I'd been trading for 2 months. And we had the crash on the Monday the 19th, and then on the 20th was a 90-day Euro-dollar interest rate move it was a 37 standard deviation move based on the prior year's volatility. The Swiss franc move that we had recently was a 45 standard deviation move based on the prior 100-day fall. Yeah, it kind of makes me smile, and it reminds me of a lesson I learned back in 87. Which was, be careful with a lot of standard risk measurements, like standard deviation and variance, when markets are not always, markets, we're applying something to markets, a statistical measurement to markets that is generally applied to things naturally occurring out in the world, like the height of people or the amount of rainfall or, things like that. And so you then come to these markets that sometimes are not completely natural, and certainly the Swiss franc wasn't, and even to some extent the Euro-dollar interest rates weren't. Short-term rates, governments can change, and if people are involved, and it may not be occurring in a normally distributed fashion. And the same with exchange rates. So, no, it did, and it reminds me that the other big thing is in these markets, you've got to always be careful and trade small, not get too far out on a limb, because there's a few players out there that can saw off limbs, and you don't want to end up smashing to the ground like it happened. So, and interestingly enough, Michael, I was on the wrong side of both of those trades. I was on the wrong side of the Eurodollar trade. And back then I was trading a lot bigger because I hadn't quite learned the lesson. So anyhow, that was the worst day of my trading career ever, where I lost half my money in my account. It was a $66,000 account, went to 33 on October 20th of 89 after, 2 months into trading. But the lesson was a good one, and it came at a great time in my career because I've never traded an account so small since either. So fortunately, the Swiss franc, it cost our clients and me about 2%, but still we have had a great month. There were a lot of other things make money. So we're finishing this month up about 4.5% for January of 2015.
It's interesting. You bring up the percent loss on the franc. I can't tell you how many emails I received, I guess from people that perhaps don't understand generally the systematic quant trend type strategies. So many emails came into me immediately assuming that any leverage employed in the strategies that you employ, your peers, that somehow or another that all these folks had blown up. And I was thinking to myself, like, hold on, how in the world did systematic quant trend type strategies with sound risk management, how are you equating this with FX brokers using 500 to 1 leverage?
Right. Yeah. Swiss franc is one of 60 markets we trade. So, and the one part of the, one key component of a trend following strategy is broad diversification and small risks across lots of markets. And so, so it's very different from people who just trade in say it's just a currency trader, because a currency trader, if you're not diversified, you got to have concentrated positions, and that's the people that can get hurt worse. And we really, for us, our Swiss franc trade was a somewhat large position for us. So, so it was, and there's no getting out of the way of that kind of move. It's just slaps you upside the head, and you don't, by the time it's over, you've taken your losses. So my guys called me at middle of the night, the trade desk. We've got a 24-hour trade desk, so the folks called me, and we looked at it, and it's a little bit. It's you've got to prepare for things like that before they happen, and you don't know when they're going to happen. Once every 5 or 10 years, you're going to have a crazy event happen that you just hope you stay out of the way of, and to the best you can. And so a key component is always take small risks, and they seem tiny, but whenever you get something like that Swiss franc move that happened, even a tiny risk looks big. 2% loss, that's a big loss for us, in a year. That's a big, it'll show up as one of the worst markets for the year at that. So our best markets are, for the year will be in the, 3% range, and the worst markets are usually in the 2% range. And, and most markets are in a fraction of a percent. You're making 0.5% to 1.5%. And it's like climbing a mountain. You do it a step at a time, and you get there a step at a time. There's no big giant leaps in the way we do things.
But you had to have smiled, though, because 2%, yes, you did not want to lose 2%. But on the flip side, there are people out there that perhaps will go unnamed or unnamed funds, whatnot, that you and I both know they are sitting there in tatters right now. And I'm not gloating or anything like that. I'm just saying that ordinary risk management strategies have left multiple funds out there, perhaps we'll never know who they are, probably broke.
Oh yeah, no, yeah. If you made a lot of money, you're being quiet, and if you lost a lot of money, you're trying to be quiet, but it's going to be hard because at some point dead bodies rise to the surface, and people end up seeing it. But no, to me it made me smile, just the statistics and these risk measurements that you see people apply to markets. And I'm on my 28th year of my career in trading, and I see these people that they bring this nice box of statistical measurements from from academia, and they try to apply it to markets. And I'm always like, look, this will work for a while, but there'll be at least once a decade. You can throw all that in the trash, and they're going to throw something at you that you say should never, ever happen. And just know things that should never, ever happen do happen in the markets, and that the markets, particularly, when you get into currencies and short interest rates, those are the two that are the scariest, in that the volatility expansions historically have been the greatest. And you see the importance of risk management from a whole nother level than they taught us in statistics class, and the only way to do it is trade very, very small, and don't get too greedy at any one trade or any one moment. Just always be fearful of those coming along, because they end your career. And so, you always got to smile when a bullet zips over, and you say, okay, that's why we don't stand tall in the markets. We kind of hunker down and don't get too big.
Let me ask you one last little question on this Swiss franc topic. So, an artificially priced market like the franc, and I think the analogy, a dam building up. And so can you talk about the notion of these artificially priced markets? Now, of course, you're not in the business of making predictions, but you structurally also are well aware as to how markets are situated and how governments can participate unexpectedly. Talk about the notion of these artificially priced markets around the globe and how these dams can get built up with a certain amount of pressure.
Well, I like your dam analogy. I used that same analogy recently about a dam because, I was talking about 100-year floods, and statistics, again, are designed to measure, these statistical tools are designed to measure naturally occurring events or situations. And so it would work with, say, a 100-year flood, and you would say, okay, well, 3 standard deviations and this kind of thing, and 99.7% of occurrences should be inside of 3 standard deviations. And it changes when you get people interfering in a naturally occurring event. It's very similar to if you build a dam. And so if you build a dam on a river and then the dam breaks, it's a very different flood than the 100-year flood that would have occurred. And it's much more catastrophic. And I think, in the markets we see that, in, the interest rates with, the central banks around the globe, they've got the interest rates in a headlock, and they feel pretty confident they can control those interest rates. But, we've all seen markets where central governments tried to control things and they didn't do a very good job, or they did a good job up to a point and then it broke loose. And that's what happened on the Swiss franc. The bankers here at Swiss National Bank had to be sitting around as they're printing these Swiss francs, trying to keep their currency weak, and it must have seemed really silly, the quantity of Swiss francs they're printing, and they just look at each other and they say, we just can't keep this up. And then you break the dam. Then how do you break a dam? How do you once you've got all this water backed up, there's not an easy way to let it go. There's a lot of ugly ways to let it go. And so they just picked the easiest one and just walked away and let the whole thing collapse. And it's dangerous for traders when you've got people interfering with markets. And, most markets, you don't have that. You get markets like, say, the grain markets or cocoa or the metals or energy markets. They just swing around and they're wild all the time. But you get someone with a market in a headlock and everyone gets you lulled into this sense of complacency that, oh yeah, this isn't very volatile. But you got to be careful. It's kind of like dynamite. Dynamite's not volatile till it goes off, and then then watch out. Yeah, so it just sits there, looks real innocent until boom. And so that was the Swiss franc, and it was interesting in '87, the crash of '87. That when Eurodollars, that was central banks moving interest rates, dropping. They lowered interest rates, but to help flood the market with liquidity after the crash, on October 19th, and so, it wasn't quite the same deal, but it was in that they went and had a big splash too with doing a move that should statistically never ever happen. And we certainly see other dams built up out there that you've got to say, okay, be careful of those. Same thing can happen there.
I want to jump into in a few minutes here, just some background stuff and lessons learned and wisdom you can impart to the audience. But there's one other market move that I think is really interesting to talk about. Crude oil, basically since last year, a fantastic trend, at least if one's on the right side of it. But I think what's really interesting, I mean, you're a dyed-in-the-wool speculator. I mean, you are a speculator. That's what, your business is about, speculation. And of course, running a money management business and helping clients, but at the root, it's speculation. And speculators often get an awful name in the press and whatnot. But this time around for oil, I don't hear people coming out and saying, well, gosh, thank you for the speculators for making our gas cheaper at the pump.
Yeah, no, and for the most part, you had a lot of, certainly the trend following community, they were short energy markets, and no one sent a thank you note. They were sure trying to villainize everybody when it was going up. And what I always tell people, and I think if you really think about what happens in a market, I think if we start with the premise that a market is driven by supply and demand, and if everyone can agree on that, you say, okay, which I think we can, because I think that's true. If the supply of a market and the demand of a market, that's what ultimately determines the price. Well, and to affect the supply, you have to, if there's some shortage of let's say, for instance, let's talk about crude oil back when it was going up. If there's a shortage of it, then someone must have taken that supply. And to take the supply, someone either has to consume it or they have to hoard it. Those are the two ways to take supply off the market. In order to consume it and hoard it, you have to take delivery of it. And if you see people in the futures markets, speculators, they don't take delivery. They roll forward. It's really silly for people to say, well, it's all your fault. And I would say speculators could push a market for a day, maybe a week, but eventually that contract comes up to maturity and they've got to sell it. In the end, they just held it for a bit. Say, you look at times when people have manipulated markets and cornered markets. If you ever corner a market, you've got to stay in the corner with the market. You can't walk away with money because then you've got to sell. You only make a profit. You got to buy and then sell. And if you ever corner a market by buying, then you ultimately have to sell to make money, and you can't artificially create demand or artificially hurt supply if you never consume it or hoard it in a long-term way. And so speculators changing the market, I mean, it just doesn't happen. It happens on a very short-term basis. There are moves that are fundamentally, there's a reason for them to happen. They happen, and speculators get in and they participate in it to a degree, but to make a profit, you've got to sell to someone else that wanted it worse than you. And the speculators are not selling to always other speculators. They're selling to people that really want to use the product. And so, anyhow, it's a silly argument that you hear lots of times from people that don't understand markets and they want to blame someone for a movement. But like you say, they certainly never go give credit to anybody when it moves the way they like it to move. But at the end of the day, you can try to educate people, but you can't fix stupid. And some people are intent on being stupid and they don't want to be educated and they don't want to take the time to learn. And that's a harsh way to put it, but that's just, that's what you see.
Let me take you back a step as you mentioned learning, and you're a guy that was fortunate enough to have some really interesting mentors early on. And I think one of the most interesting mentors, and we've talked about this in the past, was your grandfather. And I would love for you just to, reaching back into memory and impart some of the wisdom to the audience that your grandfather was able to impart to you just about life and markets. And because I'm sure you probably think back every day and think, well, gosh, this guy's has a good part of my success and he helping me to learn and think the right way.
I was really blessed to get to work with my grandfather and for 6.5 years before he passed away, which has been almost 21 years ago. He's been gone a long time, but he was a very successful business person and doing, deals mostly and one of the things, I think one of the best lessons he taught me for anybody in business is we were doing some land speculation. So we would buy, it's almost like, and this was in the 80s when the oil and gas boom of the 80s had gone completely off the tracks and a lot of land was being sold cheaply. And so being in the country, we were buying distressed real estate, but it's ranch land, and a lot of people in the housing world are doing that in housing, because it's fix and flip crowd. It was basically the country boy version of that, but you do ranches. And we liked ranch land, and my brothers were involved in ranch land. Well, so there were deals that we had the opportunity to buy into some deals, and they were probably, 85, 90 cents on the dollar. And I really wanted to do those. And he said, no. And I said, look, we could make some money off this. And he said, yeah, but I said, look, we don't want to do good deals. We want to do great deals. I said, don't do good deals, because when you do good deals, you tie up your time and your energy and your money. And when the great deals come along, you don't have time for the great deals, and you don't have the money for the great deals. So you got to keep your powder dry for the great deals. The patience he had, and as a young person, I was anxious to do something. And he laughed, and he said, you need to get a hobby. Relax a minute. Wait. Just, wait for the great deals. And he was right, because, a few months later, a deal comes along that's, 60 or 50 cents on 50 to 60 cents on the dollar. It's actually 50 cents on the dollar. This one deal came along, and a bank had some property, and they had to unload it fast, and they were looking for someone with cash, and we had it. And so not doing good deals was interesting advice, but really great advice. And you see that resonate with other people. I know Warren Buffett, a terrific investor, he's talked about, if you can do 10 great deals in your lifetime, this, like a coupon book, I think he describes it as. So great deals, that's one. Certainly the other big one that, and the very first thing he told me when I showed up is, just the importance of honesty and ethics and treating people right. The world's built in a circle, and you got to go treating people badly. Then at the end of the day, that all comes back to you, and you're not going to be in business very long. And it costs you in the short run to do the right thing, but it pays big dividends in the long run, and to demonstrate to people you're trustworthy. Those are probably two of the best ones that, he had. Now, I will say he tried to do deals with a lot of optionality to them, where the risk reward, and I would say it's similar to trend following in that where you limit your losses and have the opportunity for big profits. He would do that with options, where he would, make a deal where he pays an amount, just like an option premium, and then he's got this upside that he sees it's a lopsided return with a limited risk, and where you control that downside, and that's certainly something that transcends from the business world to the trading world. But so does, certainly honesty and ethics. That's important as well. And so, and even the importance of the big deals, that's, you see that in trend following. That's where you make your money, is some of these nice big moves. You make it in lots of little places, but these bigger moves, if you can get a handful of nice moves that, 2-3% moves that give you 10 to 15% a year, he said, hey, that's a good year. And I was really fortunate and very blessed to get to work with him.
Going back in time and going back to think about your grandfather, but I'm curious, in current day, what influences you today, your thinking, your business decisions, whether it's new voices or thought leaders, books, what types of influences affect your decision making today? What new things do you like to learn today? I'm giving you the hard question right now in the middle of the interview.
That's all right. Well, I love to read, and the other day I read on the plane, 0 to 1 was an interesting, you read these books from smart people like, that's Peter Thiel, and I like reading about people who've done it. I think that's what's interesting about what you do, Michael, too, is I think to listen and to talk to people who've done it. There's a lot of people that will come up and say, hey, let me tell you how to do this, but they really haven't done it. And anytime I can learn from people who've had interesting experiences and have done fascinating, amazing things, that's fun to read about. And that's where, like I said, that book, that Peter Thiel, that's just one of many examples. But he's done some interesting investing and analyzing businesses and what works, what doesn't. And so, anytime you can study from people who've demonstrated they can repeat success, there's sometimes the one-hit wonders that you go, well, I don't know if that was just one lucky, got a hunch, bet a bunch, and then you're out. You see that sometimes. But sometimes a lot of times you'll see people that you say, all right, these people have demonstrated repeated success, and they've got something they've got some ideas or concepts that seem to work. And So anytime I can do that, I like the old, the Market Wizard books Jack Swagger used to do. Those were interesting way back. What you're doing, where you talk to traders that have done it, all that. And to talk with other traders, that's always fun and interesting to see different people doing different things. And, at the end of the day, some people, they're doing something that I may never like to do. It just doesn't fit my personality. But it's still fascinating to hear about it. And you've got to respect success wherever you find it, whether it's in the investing world or in an athletic endeavor or in the arts or whatever. You see people that are that really seem to connect and have an understanding, and it's fun to just at least learn about what they're doing and what they're thinking.
I always give you a shout out because the one thing that, here I am in Asia right now, but what I think I really learned from meeting you and seeing your home, your office, was the location independence. And you had that feeling and thought as a young man, but I don't think a lot of people necessarily have that. And you chose to be in your hometown, but coming to your hometown just said, well, hold on. This just means you could be anywhere. That was an awesome lesson I got from going to Canadian Texas to actually give me the confidence to say, well, gosh, I could be in Asia. Why not? And people might find that funny, but it's true. It's the location independence aspect.
Yeah, no, I agree. Well, all you need is some way to connect to the outside world. It was, our town in Texas is somewhat a typical Western town where the railroad came through, and the railroad came in 1887 to our town, and that's why the town of Canadian Texas, that's why the town's here, and that's where the railroad was the link to the outside world. And today the link is either a satellite link or phone link, and so the links are not as expensive to build as they used to be back in the 1880s with railroads. But that link to the outside world, whether it was, in the Old West, the railroad, or today with satellites and phones and internet connections, yeah, it's easier today. And it's that same link, you need a link to the outside world. And it's easy to get that from a remote location, whether it's a small town in Asia or a small town in Texas. Most of them have a link to the outside world. And once you have that, you can do a lot. I think you can do anything, particularly in the trading world. Why not? And, what I found, I like being a little bit removed from all the noise, and I can sit and study and run my numbers and see what I'm wanting to do. It's kind of like studying in a quiet room, or do you want to study in, Grand Central Station? And if I'm studying and really trying to think, I like a nice quiet place, and I don't need the distractions. So Canadian serves as that. It's really a nice place to study and work, and then I've got that connection and hit a few keystrokes and make some trades. And so, no, you're right. You don't have to be in the middle of Manhattan or Chicago. And to me, it would be a distraction. There's too many things going on that would get my attention, and I'd just say, nah, let me just get out where there's not a lot of noise and not a lot of people, and I can think clearly. So, and good fresh air. So,
yeah. Hey, as we wind down here, let me get one kind of last question about the markets trading. So you've got a strategy that really, one of the key features is it's a strategy that's designed to the best that you can to avoid disaster. And we were talking about that early in the conversation. But talk about the notion of, so here you have this well thought out strategy, very quantitative driven. You want to avoid disaster. But on the other side of the ledger, you have so many people that have been long the S&P since March of 2009, and they just say, well, I don't need all that stuff, Salem. What disaster? What are you talking about? Look what the S&P, it's gone straight up. I don't need all the exits and the risk management and the disaster protection. It's always got to be a constant struggle with a strategy that is designed to protect against disaster. And there's no guarantees to anything, but you're always thinking about that. Whereas I think many people in the investment community, and of course you have many peers that think like you do, but many people in the investment community and their clients don't often think of disaster as one of the most important things. And I'm not trying to be a negative guy either as I bring this up.
No, I think you're right. I think people are conditioned they think they have to have, the stock market they've got to have a lot of money in it, and they don't, and they're somehow said, well, we're going to have periods where we lose a lot of money in this market. And you look, I look back at history, and history's important. I mean, history gives you an idea of at least none of us can see tomorrow. We don't even know tomorrow, let alone next year, the next decade. But certainly we can look back in history. And in the very recent history, even 08 and 87, back to, the crash in 1929 in stocks will occasionally hand you a loss in the 30% range, somewhere 20 to 40%. That's not uncommon for once, every now and then to get that kind of a loss in stocks. And I think somehow people think, well, this is just what we're supposed to do. And it's like not wishing for something that could be better. And then also they think in the way of diversification, what I see too, they do this diversification, have this diversification idea that, well, we want to diversify. On average, we want to be diversified. And so they get this big correlation matrix and they look at, say, monthly returns over time, and they say, well, I'm going to be long this stock, and then whether it's value and growth or different, emerging markets or venture capital and all these different equity components. But at the end of the day, they're all equity and they're all business. And when the world has a big economic downturn, they all go down. And so they say, well, on average, they're not diversified. But then when the whole thing, when the economy really tanks, they suddenly, people have this thing, well, there's sometimes the correlations all go to one. Well, you say, well, yeah, if so many of these investments are along the economy and they get smashed occasionally. And then you see what we do, and you look historically for us. I mean, we haven't been for hundreds of years, but almost 30 years, and our worst year is down, 10.9%. And you think, well, that's not as painful as 30. And then two, you see that we can make money when everything does go down, like in 2008, where we made 30%, and a lot of people in the managed future space, I think the average was up about 15%. And so you see this huge opportunity for diversification. And what I always say is, it's diversification when you need it. A seatbelt that works every day except when you have a wreck. You're like, well, is that really a good seatbelt? If it doesn't work in the wrecks, and who cares if it's working on the average day when I'm not having a wreck? And you say a diversification model of all these different things that are along the economy, where, all these equity components that occasionally get smashed, and you say, well, I'm diversified though, it works. It says, yeah, but you're not diversified when you really need it. When you really need it, everything you have all this pain. Why do you want a diversification model that in the wrecks doesn't work? I mean, does that really make sense to anybody? It doesn't make sense to me. I want something that, I want to look at when things all fall off the tracks and we have a really big economic downturn. What are the things I can be involved in and invested in that have a chance of making money and that are not going to get drugged down by this economic collapse or downturn? And that's where it's hard to find. It's a short list of things. Managed futures, though, are on that list. I think managed futures, I think you see global macro, which is really a kissing cousin of managed futures. It's the same kind of thing. Those strategies in the hedge fund space can do well. And I think people doing this type of trading, they can also do well. They can, there's opportunities to make money when everything's going down. In 08, people say, well, how do you make 30% in 08? I said, well, we were short, our biggest trades, which are not big trades like we've talked about, short nickel, zinc, and orange juice. And most people didn't make money with nickel, zinc, and orange juice going down in 08. And then, even in 2014, we were up 21%. We had a great year, but we made money. Our biggest money makers were in the meat markets. We were long the cattle and long the hogs, and then long milk. Those were some. Now the 10-year rates made us some money, and we made some money in currencies too. And so a lot of different things. But it's interesting with hogs, long hogs and long milk were two of our big winners last year. Well, this month we're short hogs and short milk, and milk has been a break even this month. But hogs is one of our best money makers this month, and now we're short. And so it just helps illustrate the point that, hey, things up, things down, we don't care. Things moving, that's what we want. And when things are moving, there's opportunity to make money. And that gives us also, does the economy going down hurt or help? We're like, well, actually, if the economy really thinks big, it's probably going to be a nice big move. And nice big moves we can make money off of, like '08. It's a great diversifier. It is funny how people somehow want to accept a 30% drawdown in one investment class, and they're happy to put 60% of their money in it. But then they look at futures and they say, oh, it's risky. And you say, well, it doesn't have to be risky if you trade it right. Just like a Lamborghini. A Lamborghini can drive around 5 miles an hour everywhere. And just because it can go 200 doesn't mean you have to drive it 200. And the same with futures. It's got huge leverage, and that tends to scare people, the opportunity for leverage. But I mean, it's truly like driving a Lamborghini at 5 miles an hour. And people, we just don't use the leverage. It's like, well, it's got a lot of speed there. We could use it, but it's dangerous to drive fast. We don't like to drive fast. I think it's a good point. I think you make a good point, though. People should look harder at managed futures and the opportunities. And I think they're beginning to. You see more and more people, even big institutions, looking at it and seeing the opportunity for diversification. So hopefully that continues.
I think some people, maybe they want to make money in a certain market. And you wake up each day and you say, hold on, I'm going to manage my risk. I'm prepared to make money from whatever market moves in the direction that I'm going right, or the direction, following along the direction of that market. So, but you're agnostic. You're not waking up and saying, I must make my money in Apple. I must make my money in Google. You're not doing that.
Right. No. People ask me, well, what do you think's going to be the big markets in 2015? I'm like, I've got no idea. I said, but I'm ready. You've got to be there, ready. And like you say, do we care? No. Do we care up or down? No. We care that there's some movement in a market someplace that we can see taking place and jump on board. And so, yeah, it was last year, meats and milk and some currencies. What's this coming year? Who knows? And the energy market's down. Maybe energy market's up. Maybe we have a drought. Maybe, in 1988, huge drought, grain prices doubled. Maybe, who knows? Maybe it's something in the softs. Maybe it's orange juice. There was a year orange juice and base metals made me most of my money. It can be anywhere. You're right. And it can be up or down. And I've made, having done this so long, I've made it lots of different markets and every up, direction's up, direction's down. It really is. You're not limited to one space. And you mentioned like the currency traders earlier. Some people some people even in the futures markets will limit their space to one sector. You get people that just trade energy, so just trade currencies, and that to me is tricky. You're like, well, if you're just trading, say, energies, what if the move's in grains, or what if it's in cocoa or sugar or coffee or the metals? Or so we trade 60 markets. We're looking for 5 to 10 good ones every year that are really going to shine, and that's all we need. But you want to kind of have a big group in the room that you can say, all right, who's feeling like doing a big move this year, and that's what you need to make your year.
Question: Have you, as we kind of close out here, have you visited this part of the world? Have you been over to Asia yet?
I have. I went to, I have 8 kids, so we've got a whole tour group all in our own family with 10 of us, so 8 kids and my wife and I. So we went to China. It's been 3 years ago, and we did a big 20-day tour of China, and it was an amazing trip. We really had a great time, and wonderful people, interesting economy, and the things that people are doing, and a fascinating area. Would love to see more of Asia, because I know there's a lot of other places outside of China that are doing fascinating things. I know, like where you've been in Vietnam and Singapore and different places.
Once you see China like that, though, unless you're talking to another American that's seen what you've seen, it's almost hard to explain what you see on the ground, isn't it?
Oh, I agree. Well, you see what's in the news, and the news is not everything. The news is the interesting things or the shocking things going on, but the real life is everything. And so I think that the keyhole of the news stations is not the keyhole. That's not the full picture. And so to go meet people and to talk to them and to go in their house and eat, we would go and we would go and eat dinner with them and talk to them and understand what what they do every day and where they go to work and what their routine is and where they shop, go to the grocery stores, which they don't have. They have these markets, and you go and you buy things there, and it's fascinating. And it's just, you see their way of life and what they're doing, and then you have a better understanding of, okay, I see what's happening here. And, certainly with the number of people in Asia, they are a big factor in the world and what they're doing. And it's like our family of 10. If we come eat dinner at your house, or if a family, of 3 come over, it's a different, different environment. You got a lot going on with a family of 10, and you got a lot going on in Asia with a lot of people. And with a lot of people, you can have some interesting things happen. So no, it's fascinating. I know you're having an interesting time over there.
I got to share with you one quick thing that you would love to hear. So at 13, I had a chance to present to, I think, 5 of the top 10 largest Chinese mutual funds in their offices in Beijing, Shanghai, Guangzhou, Shenzhen. I think it was in Beijing. It was China Asset Management, which I think is the biggest. And so I'm in a room giving a trend following presentation to 30 guys. And of course, you're in a money management facility like that in Beijing. These are probably the smartest guys, some of the smartest guys and gals in China in the room. And they're using a translator, so they're not giving any indication of English. Okay, when I've done the presentation after 45 minutes, all of a sudden I start getting peppered with questions in perfect English, right? And the funny thing is they all knew about this one Chinese investor who had made billions, and his whole strategy was buying right as markets were about to kind of lock limit. And so they were all, it was traveling around and giving presentations in all the different countries. China was the one country where they really seemed to have this idea of buying strength and selling weakness, a deep understanding and appreciation of it. They had known other Chinese investors, kind of a modified type trend following strategy, but they really got it. It's going to be interesting to see how things unfold.
You bet. Well, you see in China, I was always amazed at the interest in really entrepreneurship and business, and from the farmer that's out with his little plot of land, or someone that's doing something in the cities. There's a lot of entrepreneurs in China. That entrepreneur mindset is alive and well, and people tend to think, well, this is a communist country, and I'm like, you go grassroots. This is a country of entrepreneurs, and so I could see that, and I could see they're fascinated with markets, and there's a lot of very interesting people there, and like you say, a lot of smart people, smart people.
Yeah.
When as a statistician, I know if you have 10 people and you find the smartest person out of 10 or the smartest person out of 1,000, you're going to get probably a smarter person out of 1,000. Just you've got the odds of a really unusually smart person, and so when they go pick out the smartest of their bunch, they've got some really smart folks that are, I'm sure, going to be doing some interesting things going forward. And so, and very friendly people, and really, we felt, we were very welcomed there. Yeah, it was fun.
Well, thanks again for coming on, Salem. I appreciate it. It's been a while since we chatted. Hey, Asian Godfathers by Joe Studwell. Great book to read about the development of various parts of Asia. Great stuff. But hey, thank you for coming on today. And, hopefully we can catch up again in the not too distant future. And I think people always love hearing your wisdom, and you got great experiences and a lot to learn from. Appreciate it.
Great, Michael. Thanks for having me. It's always fun to visit with you. I appreciate it.
And finally, my third guest on this show, Brian Proctor. Brian, Mike Covel.
Hey, Mike. How are you?
Not too bad. Not too bad.
You get up early. You sent me an email at 4:00 in the morning.
Well, I'm in Saigon.
Oh, you are? Okay.
So the real question might be, who was getting up early?
Well, I got up at 6, and I looked, and I'm like, I got an email 2 hours ago. I'm like, holy cow.
You're like, oh, wow, this guy's really off his rocker.
What's going on in Saigon?
Let's see. I've been doing this podcast for 3 years, and I've been in and out of Southeast Asia since early 2013. I came here. I came here on a speaking tour. I was living in San Diego, and then one thing led to another, and I said, "Wow, this is kind of a cool place. I can stay here." So now I do all these crazy podcast episodes from Southeast Asia, huh?
Wow. Okay.
Hey, I was trying to think when we met, and I was writing it down. I think it was June of 2010 in Chicago at an MFA meeting, if I'm not mistaken.
I think you're right. I think we met because we were listening to a panel that had my old boss Rich Dennis and some of the guys and girls that I knew very well up to talk about their experiences with the mentoring program that Rich ran.
Yeah, well, obviously, and you were a part of that too. But let me jump in. So, as a managing director of EMC right now, commodity trading advisor, managed futures player, long track record back to 1985. And since you just kind of brought it up, I think it'd be a good thing to start with the audience, and then we'll kind of bring things forward to today, because it is one fascinating, and I'm sure there's probably a side of you that's like, oh my gosh, I don't want to have to say anything anymore. But it's still so fascinating to people out there to realize, and I guess for you, maybe it feels like a long ago school program, but it just so happens to have been a school program that was a very successful one. Why don't you talk about, Brian, I'm really curious, your first trading moments, how you got started, and what led you to the Turtle program?
You know, like Rich Dennis, I grew up on the south side of Chicago. So when I graduated from college in 1982 with a degree in, a degree in economics, I went out and there was a big recession going on, and I thought I was going to get into investment banking somehow. But as I soon found out, they were laying more people off in the banking industry in Chicago than hiring. So just by chance, I ended up playing a round of golf, and in my foursome was a guy named Everett Clipp who ran Alpha Futures, a big FCM, a big clearing member at the Board of Trade, where a lot of locals would clear their trades. As I played with Everett that day, he was asking me what I was going to do with my life, and I wasn't really sure, and I asked him what he did, and he started to tell me about the trading in the pits of Chicago, and I had heard about it but never seen him before. So, I bugged him a little bit, and I said, I'd like to come down and see how everything works down there, and if, maybe find a job down there. And he tried to dissuade me from coming into the business. He goes, no, you don't want to get in this business. It's a bad business to get into. Lots of people start in this business. They lose money. I wouldn't suggest it. So he kind of put me off. But I wouldn't take no for an answer, so I kept calling him, and finally invited me down to his office and showed me around and took me down to the floor, which was a tremendous experience. I'd never seen it before, and the minute I walked down the floor, I realized this is what I wanted to do. It was just that overwhelming. And so Everett. God bless him. He was a great guy. He took me under his wing, and he said, I think I can help you find a job. And there was a new firm starting up. The name of the firm was C&D Commodities. It was two guys, very famous locals down in the grain room primarily, Larry Carroll and Rich Dennis. And they were just opening a brand new firm, and Everett got me an interview at C&D, and I was probably, I want to say, maybe the fifth person they hired there as they were starting their new firm. So I got thrown right into the fire from the very beginning and worked on, started as basically a runner, phone clerk on the floor of the Merc first in the old black box when the Merc was, in its infancy. And then worked there for a while, and then moved over to the Board of Trade and kind of climbed the ladder at C&D pretty quickly, just because I'd gotten in the door first. So it was, just a good stroke of fortune for me to have that opportunity, and I learned a lot. There were guys on the floor running the show for Rich Dennis, Danny Smith, Jack Callahan. Those guys, always at work every morning, 5 o'clock, ready to go, great work ethic. And set a great tone and a great example for me. So I lucked out. So I got into the turtle program really. I was running the floor operation in the grain room for Rich when he first decided to open or start this program, and he put the ad in the Wall Street Journal, and we'd come upstairs after the trading day was done, and there would be literally, gigantic bags, sacks from the U.S. Post Office in our office, and we'd have to kind of weed through the mail and sort it, and Rich and Bill Eckhart and some of the other guys up in the office would weed through these. And so, I witnessed the first round of turtles, if you will, that came in, and saw how successful they were. Over the course of the next year, Rich decided he was going to open it up and do one more round and bring in another, half dozen to 10 more traders into the program because it was doing so well. So it was at that point when I went to him and I said, look, what's my career path at C&D going to be here? Am I going to be, go into the pit and get a badge and execute trades for you, or with this turtle program, would I be a candidate? And, what would you suggest if you were me? And Rich said, you can skip the floor, because even if you get a badge and you go into the pits, you're going to get tired of that mentally and physically, after 5-10 years. So why don't you just skip that phase and go right off the floor and start to learn how to trade off the floor? So that made it easy for me. I said, well, if you would consider me for the turtle program, the second round here, why don't I make that move? I didn't have to go through, per se, the big, long interview process and answer. Well, I guess I did answer the questionnaires that he put out there. Anyway, that's how I got my start in the business. It was just kind of a stroke of luck that, ended up being in the right place at the right time. And, obviously the turtle program and the opportunity that Rich afforded all of us was an incredible opportunity. It gave you the chance to learn how to trade and take the emotion out of it, because it wasn't your money, it was Rich's money. As you know, that we used a high degree of leverage in the turtle program, so the opportunity to make triple-digit returns was there. Where our margin to equity was very high.
I'm looking at your returns that I jotted down for while you were in the program. 85, 55%, 86, 116%. In 1987, you had the highest return of any of the turtles in the program as 185%. So yeah, you're right. You guys were shooting for big returns at the time.
Well, I actually, in 1987, I lucked out a little bit, just because at the time at the time, a little bit before I started the turtle program, I decided that since the trading day back in when I started on the floor, we worked from 7. Well, actually, we got in the office around 5, but the trading day would be done by, if you worked in the grain room, you were off the floor by 1:30. If you worked in the bond room, you were off by 2 o'clock. So I decided to go to law school down the street at John Marshall and get a law degree in the evenings. So I had a little time to study and then go to class. So I actually was literally the week and the days leading up to the 87 crash, I was taking finals in law school, and rather than worry about a lot of positions in my portfolio, doing my homework and working on the trading levels and stuff, I took a lot of my positions off or scaled back a lot of the positions going into my finals week in law school. When 87 happened and there was, a big disruption in the market, especially in the short-term interest rates and currencies, besides the equity market, I had very little exposure on, so I didn't take the gigantic hit that a lot of the other guys in the turtle program. So that was a stroke of luck, actually. It had nothing to do with my exceptional brilliance or anything in that particular year.
Let me talk about one aspect of the program that I think is interesting and comes up to modern day a little bit. I think there's been a couple, I don't want to call them experiments, but some people that witnessed from afar the turtle program and they wanted to replicate it. I think there was a British guy that was going to teach day trading to somebody or some group of people. But I think what people sometimes forget is that this program, depending on whether you came in the first year or the second year, was 4 years and 3 years. So this was a lot of time. And, I think people want to think that there's something to film, there's some sexiness to it, but having a good strategy and sticking with it and having the discipline to stick to that strategy doesn't mean that there's a bunch of people in a room jumping up and down like the trading floor. And I think still to this day, people want to imagine some physical activity. And whereas I think you'll probably have added this, it's more of a cerebral game.
Definitely. I mean, it's, there's a lot of, when you're building systematic trading models, when you have, the blend of systems and you have your risk management parameters preset, then it's really, there's not a whole lot of excitement. You have some busy days, and in the old days we used to be on the phone a lot. You'd have to call the floor, you'd have to call, the sugar, the people in the softs pit, or you'd have to call the crude oil or at the board or the Merck. So you had a lot of phone calls to make trades when there was a big burst of activity, but a lot of time, there was just a lot of downtime so you could spend that time, either looking at new ideas or trying to test new ideas or, doing homework in some other area. So you're right. I mean, there wasn't a whole lot of activity or emotion, when the time came, having a disciplined approach. Actually, that was the hardest part, was to just have the discipline to do what the system, when the signals are generated. Sometimes it was counterintuitive. You'd look at it and say, I really don't want to buy the market up here. I don't want to sell this. I remember being short crude and taking a short position at below $10 a barrel back in, I think it was 87. So, that probably was the hardest part about what we had to do was taking some of these trades that were very difficult. And Rich always said, doing the hard thing is when you do the easy thing, you're probably going to lose. You do the hard thing, and it's probably going to turn out okay.
That confidence that was instilled at you at a young age, that's something that's never wavered. I mean, for example, in the last 3, 4, 5 years, it's been the latest rounds of systematic trend following, CTA style trading is dead. Now, from your perspective, going back to the early 80s, I'm curious, how do you feel when you see these stories? Because you're looking at the markets and systems from a much different perspective than what people that are not familiar with your style of trading. They see the headlines and they get excited by the headlines. But from a confidence perspective, really well deep in your gut, those headlines don't really amount to anything. It's all about the system, the rules, sticking with it.
Absolutely. That was, Rich said, the two most important things you can learn from this program are, number one, you have to be very disciplined, manage your risk, take your losses, have an unwavering discipline when it comes to that. And the second most important thing is, when you're doing your testing and you're coming up with new trading ideas, new trading models, to just have some very robust parameters out there to make these systems operate. Honestly, I mean, our best systems now, if you have a system that has a 40% winning percentage over a long period of time across all the markets we trade, that's a phenomenal system. And so what that tells you is you're going to have more losing trades than winning trades. The discipline of letting your winning trades run and cutting your losses is where you make your money. It sounds simple and you hear a lot of people say it, but the truth is, it can be a very difficult thing to do month after month, year after year. So when we do go through difficult periods for our particular style of trading, such as after 2008 up until 2013, we had an up year, down year, down year, up year. We kind of went sideways to negative for quite a long time, the longest period I can remember in this business. And it would have been easy to kind of say, maybe our models are broken. Let's change things and let's move to, let's do things differently. And we at EMC decided, not to do that. That, we've seen these kind of periods before. You never know when the next successful period is going to come for our style. The financial engineering that was going on around the world, the central banks and the governments of the world propping up asset classes and trying to control interest rates and currency flows and things. They were obviously very successful at that, which made it difficult for us. But, we'd see little glimmers of hope of markets starting to diverge and follow their own kind of supply and demand, or, the other fundamentals that normally drive markets. And so we were cautiously optimistic that that at some point, the long sideways to negative performance would end, and of course it did. Over the last, for us over the last 12 months, it's been, in our classic program, close to 40% over that time period. That's just the nature of our return stream, and if your investors understand that and they're comfortable with it and they know it's a long-term investment, they're going to understand we're going to have periods where performance is going to be difficult, but as long as you have long-term positive expectation, the benefits, obviously the non-correlative benefits of adding us to an investment portfolio really make it worthwhile for investors.
Brian, EMC Capital was started by a fellow turtle, Liz Cheval. She's unfortunately no longer with us, but I'm curious if you might go back and give some perspective about working with her, what she's instilled in the firm that to this day is still an integral part of EMC.
Sure. I mean, she obviously, we were friends way back in the early days, and we got to trade in the same room together and get to know each other. And she was always, a pleasure and a wonderful person. Over the years, after the Turtle program ended and everybody went out on their own, Liz formed EMC. Through her perseverance and her personality and her intellect, she partnered up with a couple of very good partners in this business, that being Dearborn Capital Management and Morgan Stanley. She cultivated those relationships very well over time, in addition to having great performance for them. Her ability to run a business as well as be a successful trader was, it's just a testament that EMC is still running here, even though she's passed now for 2 years. All those values were instilled in the people here at EMC. I've been here for 10 years, so I went off and did my own thing. I ran a CTA for a while. I went back and ran Rich's trading operation for a while. I moved to New York and traded for a hedge fund, a long-short equity firm for a while, and then came back to Chicago, met up with Liz, talked about our business. I ended up here, which was very fortunate. The carryover from the lessons that Rich and Bill instilled in us, still the same basic philosophy. You're looking to continuously look to improve your trading models or build new trading models that complement the ones in the portfolio. So it's an ongoing discipline of continuous research, using the advances in technology to your benefit. So now we've reinvested enormous sums of money back into our infrastructure here in terms of research and trading, so that we're at the forefront of quantitative analysis here, and then to have the discipline to build systems based on trend following and momentum. It's always about directional price movement. It's never about trying to pick tops or bottoms, and then implementing them in a way that you spread the risk out across the markets and the systems that you trade. Get as much diversification as you can and manage your risk. It's really all about having a big database across numerous markets, lots of data points, daily data for 80 markets looking back, 20 years. So it's how do you efficiently and with a certain degree of speed, how do you look at all those possible variables when you're building a trading model that might have anywhere from, say, 8 to 13 parameters, the parameters being the type of price action that gives you initiation signals, the type of price action that gives you how to liquidate those trades. And then there'll be filters, there'll be filters in there that deal with things like volatility or delays or things like that. So, when you're optimizing a trading system using this newer technology, what it basically allows you to do is open your parameter sets much wider than you would have been able to in the older days when you did a lot of this by hand and then went back to the machine and had them rerun. So the biggest benefit is opening up the parameter sets and allowing the speed of the computers to just do multiple iterations, just millions of tests. It's a natural progression of the best parameters in the trading model rising to the cream rises to the top, and that's how you optimize your trading system. Obviously you have to be aware of possible pitfalls that come with curve fitting. To get around that, you don't optimize to one metric. You use a blend of metrics, and by that I mean you can mix a return element with another concept such as efficiency or sortino or something like that. That's one way to prevent curve fitting. Another way is to obviously create an out of sample hypothetical return set and then compare that to what you actually were producing when you're re-optimizing existing systems or building new systems to see if actual trading mimics your hypothetical returns.
There still seems to be a significant number of traders, your firm included, though, that do have core trend or systematic approaches, trend following type approaches. And do you ever find it kind of amazing when you look back and you say, wow, some of these men that I learned from all these decades ago, and look, Richard Donchian before Rich and Bill and some of the other guys in the 70s, it's amazing that these core philosophies and many core strategies have continued to excel.
It's just a testament, I guess, to human nature. Markets are not always rational. They're not always efficient. On top of that, there really are things that drive markets besides human emotions, whether it be supply and demand or changes in technology or geopolitical events or some kind of economic upheaval. When those happen, a divergent strategy like ours, that assets are going to be mispriced across the board. There's going to be some sharp money flows in response to the mispricing of asset. The efficient market, when things are status quo and the world is not in upheaval, then you're going to have slow, steady, progressing markets. Over time, from one decade to the next, there's always the unforeseen, the unexpected, the sea change in one asset class or a number of asset classes that people have to react to, and you get long, pronounced trends. If you have systems in place that are designed to capture those, and you have the discipline to, say, get short crude oil at $100 a barrel, if it goes down to $80, a discretionary trader may, if there's a little bit of consolidation there, decide to take the position off, and then it may gap down $2 the next day, and it makes it hard to reinitiate a position the next day unless you have that mentality that, this trend could continue much further than, I envision right now. Yeah, it's amazing that these programs, that, the old guys, the pioneers in our business envisioned working and experienced, they really understood the nature of the markets, and that there will be great profit opportunities in a wide variety of markets if you have the discipline to do it the right way.
They're not going to hand out the Nobel Prizes to traders anytime soon, I don't think. But all of the guys that get these Nobel Prizes, and some of them are extremely brilliant, I'm not taking anything away from them, but it seems like some of the traders that actually figured out all their lessons that they got the Nobel Prizes for long long time ago already in the markets, in the pits, etc.
Yeah. Well, I think if you asked Rich or any of us, we're not anywhere close to being that deep of thinkers or that much in academia. It's just kind of a learning experience.
But it's the results.
It's more of putting your nose to the grindstone and doing the right thing day after day than coming up with some world changing.
Let me ask you about diversification. I received an email the other day, and somebody was asking me about the Swiss franc move in January, and I've talked about this in my podcast before. Other people have commented on it. And this person wrote me, they said, I don't understand these strategies, the quant trend type strategies. If they're trading the Swiss franc in January, how do they not lose 30 or 50%? And I think what people don't get is that, and I want you to comment on this and talk about this, is that you're not betting the ranch on each market. That's number one. And then number two, if you do happen to have losses, which you're going to have, there's also going to sometimes be gains, and the gains can offset the losses. Why don't you talk about that? Because I think that's a big picture concept that you might even face with. I mean, these days, I'm sure many of your clients get what you guys do, but still, there's going to be very bright, very wealthy people that still might not appreciate this idea that, well, we didn't get blown out on the Swiss franc because our position size was such that we weren't going to. And then number two, our other gains can offset. What do you talk about that, Brian?
Sure. Well, there was that was kind of a unique situation because of the peg that the Swiss National Bank had put into place. And once it got below that peg, and there were traders out there, certainly discretionary traders, who looked at it and said, what's the risk here? We got the ECB about a month away from their new QE program, if you will. So there were guys who looked at that and said, something could happen with the peg here. I'm not comfortable with this position, and just took it off. We didn't do that. We were still short the Swiss franc, but as you said, every trade that we take, there's a limit to the amount of risk that we'll put in any one trade, in any one market, in any one sector. The risk of ruin gets greatly reduced as you spread the risk out across 80 some odd markets across the globe. The Swiss franc only is going to get a certain small percentage of the total risk in the portfolio. Now, that said, for us, on the day of the decision to remove the peg, we were short. We lost a little over 2% in the Swiss franc that day. But at the same time, you have to remember we were long the Euro Swiss, which was the interest rate component of that. So the Euro Swiss actually that day and then for the ensuing week after that had a tremendous rally as the short-term rates went further into negative territory. So, we had the diversification to offset a lot of the loss that we took in the Swiss franc that day with some of the interest rate exposure we had there, plus being long the DAX, which has gone up about 25% since January, because of this QE program and because of what's going on over in Europe with the attempts to stimulate their economy. The diversification really does play a role. The limit of risk in each market and in each sector that we trade plays a role. We've seen currencies go through pegs before, and we've seen, banks and central banks and other entities, say one thing and do another thing. So we really can't base any of our trading decisions on what might happen or might not happen. Our models are really designed to react to what's going on in the marketplace rather than try to be predictive.
I have this jotted down in my notes here, quote, every now and then the impossible can and will happen, end quote. And it's such a simple thought, but how many of us go wrong on that, huh?
Yeah, I mean, every now and then you do get something that just defies logic. I wouldn't say this defied logic. It was just an event that, in retrospect, you can look back and say, oh yeah, we should have seen that coming, or oh, that would have been really easy to predict. But the reality is, in the moment, as you're looking at it, you don't know what's going to happen, and the Swiss obviously have been are very good at being secretive about what what they do. So, for us, it's responding to things that happen in the market rather than trying to predict the next black swan or trying to imagine the next gigantic price move in some market. You just have no idea.
I did not ask anything in the beginning of our conversation today, but I'm curious, looking back in time, how were you influenced by Bill Eckhart?
By Bill Eckhart? Well, Bill, was kind of the quant of the duo of Rich and Bill. I think Rich was the more intuitive trader, started in the pits and had a knack, obviously, for assessing situations and was comfortable taking risk and managing that risk, and obviously built a fortune. He recognized the brilliance of Bill and his mathematical approach to trading, and so it was a good partnership for them. You had the intuitive ideas that could be, or at least attempt to put those ideas into mathematical equations. And so it was really, I think their partnership was great, in that each one of them kind of had a unique contribution to the overall success of their partnership and of the Turtle program in general.
Yeah, I think we can all, maybe people aren't going to agree with me, but I don't think there's ever going to be a repeat of that particular event. I think the fact that it happened before the internet, where everybody wants cameras everywhere today and all that kind of stuff, I think it's just this naturally occurring event, seminar type program put in place by two men behind the scenes. And then when it was over, everyone learned of it and learned of the success. But I think it's going to be something where even 50 years from now, 100 years from now, people are going to look back and go, that was a really cool thing.
Well, being a part of it was definitely, the changing point of my life. So personally, I owe those two guys, really everything that I have right now. Is they put the programs in place and taught me some invaluable lessons and how to think about things and how to look at things. And so you're right. I don't know if there'll ever be anything quite like it. There might be something cooler that happens, honestly, in the next 10 years. For me, just being a part of it, with the friendships, I still see a lot of the guys out there, not as much as I used to, but we keep in touch, and they're, obviously everybody's program has evolved and changed over the years to one degree or another. I think, it's, just the nature of the business is how are you going to, or I guess the nature of our business, how are you going to position yourself? What kind of products are you going to build and offer in the marketplace? So, we're the sub-advisor of a multi-strategy 40 Act fund now. If you would have floated that by me, 5-10 years ago, we would have said there's no way we'll ever be part of a mutual fund offering. You just, you never know. Your business models and investor appetites ebb and flow and change over time. If you have a nice suite of products, if you will, that you can offer them, we kind of have a little something for everybody here, I think.
I'll leave you with this. I saw a comment recently and from one of your Turtle peers, and essentially said, hey, before we rule active strategies out, before we say that they're no longer valid, let's let the equity bull come down a little first. So I think it's interesting that even given the massive equity bull of the last 4, 5, 6 years, it's amazing to look at the performance from a lot of trend quant strategies, especially in 2014. Not everything goes up. I think it's going to be really interesting to see as the years unfold. And this is not a prediction or anything. I have no crystal ball, but I think everybody with a pulse out there knows that your type of strategies do extremely well when turbulence appears.
Well, historically we have, and I hope that proves to be true when the great unwinding begins to happen here. And honestly, it's impossible to decipher how it's going to unfold. Whether, when the bond rally finally ends, how it's going to end, why it's going to end. The equities will probably have an adverse reaction when that's happening. So it's going to be, we haven't been here before. So really, it's anybody's guess how it's going to, anybody can say it's going to end badly, but maybe it won't end badly. Maybe it'll be a smooth unwinding. Maybe it'll be, it'll just be markets will kind of go back to normal, and it's impossible to tell, honestly.
Your strategies will go either way, though.
Exactly. I mean, if there are money flows out of bonds and into other asset classes, we will be selling bonds and buying those other asset classes. Or, if the equity world gives back some of these extraordinary gains that they've built up over the last few years, then we'll be short in the equity markets and profit from, whether it's a relatively short downturn or a more steep, dramatic downturn. You're right. I mean, we're positioned, and our models are nimble enough to be able to turn and profit from any directional price movement in any market.
Brian, I can't keep you. I'd love to have you on again. Where's the best place we can send the audience to check you and your firm EMC Capital out?
Our website is www.emccta.com. And then, there'll be some information on our firm, our programs, and a way to contact me if you'd be interested in talking about our programs in more detail.
Brian, I appreciate you taking the time today. How's Chicago weather this morning?
Well, it got cold finally, but when I was walking the dog last night at 7 o'clock, it was 70-something degrees. When I walked the dog one more time at 10 o'clock last night, it was 50 degrees, and now it's in the 30s. So we're getting a little blast of cold, but, spring's right around the corner now.
Well, the next time you stop by Southeast Asia, I can give you a little dose of not cold.
Last time I was in Singapore, it was like 90% humidity in the mid 90s, and I thought, oh my God, I couldn't live in this. Walking down the street, I was drenched in sweat within 5 minutes. I
mean, the only thing I could wear are t-shirts. I mean, I can't. If I put a long sleeve shirt on, I'm dripping. Hey, listen, Brian, okay. Thank you for joining me. Take care.
Yep, Michael, thank you.
Now, seriously, did you not learn something from those three men? How could you not? Those three guys basically just gave you the keys to the candy store. They just told you that everything that Wall Street pumps out is wrong. Or at least they're giving you an alternative view that most likely you've not thought about. That alternative view is worth its weight in gold as long as you act on it. Thank you for staying with me for all these years. I plan on delivering the best quality content that you can find on just about any podcast. So again, thanks for staying with me, and stay tuned. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.